There's a story every student of economics learns. Simple tulip bulb, which for a brief, you've all heard of it, Tulip Mania. It's the ultimate parable of financial insanity. We use it as a shorthand for every speculative bubble since it's the story we tell ourselves about how markets get hijacked. That the tales of ruined families and economic collapse were wildly exaggerated, a far more real, far more terrifying financial catastrophe unfolded. One that didn't involve a luxury good, a collapse so total. This is the story of a market hijacking so profound, it made the price of a tulip look like child's play. We're not in Holland anymore. It was the German market itself. Today, we revisit the idea of market madness, but through the lens of a story that is far more relevant to our modern fears of inflation. This is the true story of how a nation's money turned to dust. Part 1. The stage and empire's promise, and a fateful decision to understand how the German mark became worthless. Before the chaos, before the wheelbarrows of cash, there was the German Empire. In the early 20th century, Germany was an industrial titan, a world leader in science, steel, and chemical production. Its currency, the gold mark, was a symbol of this power. As its name suggests, it was backed by and convertible to physical gold. It was stable, reliable, and respected across the globe. German citizens saved their money with confidence. But this world of stability was built on a foundation of simmering geopolitical tension. And in the summer of 1914, that foundation cracked. World War I was a conflict on a scale humanity had never witnessed, and it came with an unimaginable price tag. Every nation involved faced the same fundamental question: how do you pay for a total war? You can raise taxes, which is deeply unpopular. You can borrow money by selling war bonds. The German government, like its adversaries, made a series of decisions that, at the time, seemed pragmatic. First, they made a critical, almost silent change to their currency. In August 1914, they suspended the gold mark's convertibility to gold. This might sound like a technical detail, but it was the financial equivalent of cutting a ship's anchor in a storm. The mark was no longer tied to a tangible asset. Its value was now based purely on the government's promise. It became a fiat currency, the papier mark. Second, the government made a colossal bet. They believed the war would be short, victorious, and that the defeated allies would be forced to pay Germany's war costs through reparations. So instead of imposing heavy taxes on their own people, they decided to fund the war primarily through debt. For 4 years, the war machine churned on. The amount of money in circulation was steadily increasing while the amount of available goods was shrinking due to the war effort. This is the classic recipe for inflation, and its colossal bet had failed spectacularly. The nation was now saddled with its own monumental war debt, and the currency that was supposed to see them through was already dangerously diluted. The storm had passed. Part 2. The origins of the collapse, a peace to end all peace. The end of the war did not bring peace. For Germany, it brought humiliation and an economic burden designed to cripple it for generations. The Treaty of Versailles. The treaty famously contained the war guilt clause, forcing Germany to accept sole responsibility for the conflict. This was the moral justification for the financial punishment to come: reparations. The final bill, presented in 1921, was staggering: 132 billion gold marks. Let's put that number in perspective. It was more than double Germany's entire national income in 1913. The famed economist John Maynard Keynes got a British delegate at the conference, resigned in protest, calling the treaty a Carthaginian peace that would lead not to stability, but to further conflict. He was tragically correct. The new, fragile German democracy, the Weimar Republic, was born into this impossible situation. It was tasked with rebuilding a shattered nation while also making these massive payments to its former enemies. And those payments had to be made in gold, or foreign currency.
So how could they do it?
They could try to export their way out of the crisis, or they could resort to the one tool that had become so familiar during the war. They could print money. Sell them on the foreign exchange market for dollars, pounds, and francs, and then use that foreign currency to pay the reparations. It was a short-term solution with catastrophic long-term consequences. Each time they did this, they flooded the market with their own currency, driving its value down further. It created a death spiral. To get the same amount of foreign currency for the next reparations payment, They had to print even more marks. This, in turn, devalued the mark further. From 1919 to 1922, prices in Germany rose steadily. People's savings were eroding. Life was getting harder. But it was still manageable. It was high inflation, a serious disease. But the disease was about to mutate into something far more terrifying. Part 3. The breaking point. The spiral into absurdity in late 1922, Germany, struggling under the immense weight of the payments, defaulted. The response from France and Belgium was swift and punitive. In January 1923, their troops marched in and occupied Germany's industrial heartland, the Ruhr Valley, to seize their payment in goods like coal and steel. This was a national humiliation. They urged the workers of the Ruhr to go on strike, to refuse to cooperate with the occupiers. They promised to pay the wages of these striking workers. The government's tax revenues had collapsed. Their industrial engine was seized. They turned to the only tool they had left. The Reichsbank's printing presses, which had been running for years, were now kicked into overdrive. They began printing money on an unimaginable astronomical scale to fund the resistance. This was the breaking point. In January 1923, before the crisis fully exploded, $1 cost about 18,000 German marks. By July 1923, $1 cost 350, 0 marks. By August 1923, it was nearly 5 million marks. By October 1923, it was 25 billion marks. And at the peak, in November 1923, $1 was worth 4.2 trillion German marks. The currency had effectively ceased to have any value. Society began to break down under the strain. This wasn't a number on a chart. This was a daily, waking nightmare. Wages were paid twice a day. Barter became common. Farmers in the countryside who had tangible goods were king. The entire thrifty middle-class people who had saved diligently their whole lives, bought war bonds, and trusted the state were wiped out. Their life's work turned to paper dust. Trust in the government, in the banks, in the very idea of money. The economic chaos bred social chaos, riots, crime, and a desperate search for someone to blame. The speculation that defined Tulip Mania was a game for merchants and the wealthy. This was different. This hijacked the life of every single citizen. It wasn't a bubble in one asset. Part 4. The Fallout and the Fix. A Scar on the Nation's Soul, by late 1923. Germany was a barter society on the verge of civil war. The papier mark was a joke. A radical solution was needed. Came in the form of a new currency commissioner, Hjalmar Schacht, and a new currency, the Rentenmark. The Rentenmark was, in many ways, a confidence trick. Germany had no gold reserves left to back a new currency. So, Schacht announced that the Rentenmark was backed by a mortgage on all of the land and industrial property in Germany. It wasn't something you could actually redeem, but it sounded solid. It sounded real. Crucially, the government swore to strictly limit the number of Rentenmarks printed. The printing presses, for the first time in a decade, would fall silent. In November 1923, the switch was made. One new Rentenmark was exchanged for 1 trillion old papier marks. The zeros were simply erased. And amazingly, it worked. Prices stabilized almost overnight. The hyperinflationary fever broke, but the cure left behind deep and permanent scars. The fallout was profound. While the currency was stable again, the wealth that had been destroyed was gone forever. The middle class, the traditional bedrock of German democracy, had been economically and psychologically shattered. They felt betrayed by the democratic government that had failed to protect them. This widespread resentment and economic trauma created fertile ground for political extremism. People became deeply suspicious of international finance, democratic institutions, and traditional political parties. They craved order, stability, and a strong leader who would punish those they blamed for their misfortune. The seeds of 1933 were sown in the chaos of 1923. Part 5. Modern Parallels. Echoes of the Papier Mark. The story of the Weimar Republic seems like a relic of a distant past. A perfect storm of war, reparations, and political weakness. We tell ourselves it could never happen here. But the forces that destroyed the German mark are not unique to the 1920s. The patterns are timeless, and some of them are echoing in our world today, louder than we might be comfortable with. Let's be clear. We are not on the verge of Weimar-style hyperinflation. But to ignore the parallels would be foolish. Pattern 1. The normalization of massive money creation. The Weimar government printed money to pay its debts. For the last 2 decades, in response to the 2008 financial crisis and the COVID-19 pandemic, central banks around the world have engaged in unprecedented levels of quantitative easing. Shocking data. Before 2008, the U.S. Federal Reserve's balance sheet was under $1 trillion. By 2022, it had swelled to nearly $9 trillion. This is a form of digital money creation on a massive scale. While the intent and mechanisms are different, the fundamental act of creating vast sums of currency out of thin air to cover deficits or stimulate the economy is a path Weimar walked to its doom. It's pattern 2. Supply shocks meeting high demand. In Germany, the Ruhr occupation crippled the supply of essential goods. While the government printed money, creating a scenario of too much money chasing too few goods. Repeating pattern, the COVID-19 pandemic created massive global supply chain disruptions. At the same time, governments injected trillions of dollars of stimulus into their economies. The result, a surge in inflation to 40-year highs in many developed nations. Once again, too much money chasing too few goods. Pattern 3. The erosion of trust. The final nail in the papiermark's coffin was the loss of faith. When people expect money to be worthless tomorrow, they spend it today, accelerating the collapse. Modern echo. Central banks today are obsessed with managing inflation expectations. They know that if people begin to believe high inflation is permanent, that belief will become a self-fulfilling prophecy. Workers will demand higher wages, and businesses will raise prices, locking in an inflationary spiral. The battle against inflation is as much a psychological one as it is a monetary one. The key differences today are the independence of central banks and the absence of a crushing burden like war reparations. But the core principles remain. A currency is ultimately a shared belief system. And that belief, as Germany learned, is far more fragile than we think. Part 6. Conclusion. 3 lessons from the ashes. The story of the German hyperinflation is not about tulips. It's about trust. It's a stark reminder of what happens when that trust is systematically destroyed by the very institutions meant to uphold it. As we look back on this financial apocalypse, there are 3 timeless takeaways we must never forget. Takeaway 1. Fiat currency is a social contract, not an inevitability. Unlike the gold mark, our money today is not backed by a physical commodity. Its value comes from our collective faith in the government and central bank that issues it. The Weimar Republic showed that when a government abuses its power to print money to solve its political problems, it is violating that contract. The result is not just inflation, but the potential for a complete collapse of that shared belief. Takeaway 2. Economic stability is the bedrock of political stability. The most devastating cost of the hyperinflation was not economic, but political. By wiping out the middle class and creating widespread despair, it fostered a deep-seated anger that extremists were able to exploit. A population that feels economically betrayed is vulnerable to radical voices promising simple solutions and scapegoats. We ignore the link between economic well-being and democratic health at our peril. Takeaway 3. Inflation is a process, not an event. Hyperinflation didn't happen overnight. It was a decade-long process of poor decisions, compounded crises, and a slow, creeping erosion of value that suddenly spiraled out of control. It began the moment Germany detached its currency from a real anchor in 1914. This teaches us that the road to financial ruin is often paved with seemingly small, pragmatic steps in the wrong direction. A final warning. We live in an age of unprecedented global debt. The temptation for governments to devalue their currencies and inflate away their obligations is immense. The story of the German mark is not a prophecy, but it is a permanent warning. It stands as a testament to the fact that the laws of economics are as unforgiving as the laws of physics. Pushing them too far, for too long, can unleash forces that can bring even the most advanced societies to their knees. Call to action. What parallels do you see between the 1920s and today? Are our institutions strong enough to prevent a modern currency crisis? Share your thoughts in the comments below. We read every one of them. And if you found this historical deep dive valuable, please consider liking this video and subscribing to our channel for more stories that explain the forces that shape our world. Thank you for watching.